Hi, this is Dr. Jessica Dunn, and today we're going to discuss financial markets. Financial markets are institutions and procedures that facilitate transactions in all types of financial claims. The purpose is to transfer savings from those with a surplus to those with a deficit. So stock exchanges, commercial banks, and investors all come together to establish markets. Let's first distinguish between types of assets. First, real assets, those are the physical, tangible assets, things you can put your hands on. Financial assets, these are claims for future payments, so it's assets that are on paper. And so these financial markets are facilitating transactions in financial assets. So first up, let's talk about who are the providers and the users of capital. Households typically are savers, so they're providing funding. Corporations are borrowers. In the U.S., our government is a borrower, but there are some foreign governments that are savers. But businesses depend upon households or these savers to save and invest in the businesses so that they can expand, put people to work, and provide a return back to their investors. Without financial assets, trade would be in the form of bartering. Financial assets make it easier to break down physical assets and trade only a portion of that asset. So, for example, shares of stock are a portion of a company. And so let's look at the capital allocation process. So panel A shows us a direct transfer. An example of this is when a corporation issues commercial paper to an insurance company. So they're trading their security for dollars from that insurance company. Panel B shows how the capital allocation process works through an investment banking house. So those dollars are transferred from the providers to the business. So the providers are typically the savers. We're talking about households when we talk about providers of capital. So these are the households, those savers. And that's the same, that's just true with all of these. We're transferring money from the savers to those who need it, the businesses. And we're talking about how that transfer happens. And so if we're working through an investment bank, those savers are transferring dollars through the business, but those dollars first pass through an investment bank house. So an example is an IPO or a seasoned equity offering or even a debt placement. The company would sell the security to the investment banking house, and then that investment bank would then sell those securities to the investor. So there's a stop there in the middle. The business and the saver are not transacting directly. The third panel, panel C, shows us how this capital allocation process happens through a financial intermediary. So just as before, there is a stopping point in between the transfer from the savers to the business, and that stopping point is a financial intermediary. So those dollars are transferred, and an example of this would be you as an individual, you go deposit money into your bank and get a certificate of deposit. So you're going to receive a pretty low yield on that certificate of a deposit, and they're safe. The bank then makes a loan to a company. So that company is going to pay a much higher interest rate than you're earning on that CD. But there's risk involved. So there is a chance that that company goes under and the bank recoups none of their money or a small portion. So there are different ways to raise capital. First is through a financial institution, and second is through a financial market. So let's talk about some different types of financial institutions. First up, commercial banks. Commercial banks, this is where you deposit money into a bank and that bank loans money to a business. So the bank is making money on the difference between the interest they're paying you on your deposits and the interest rate they're charging on those loans. An investment bank, these banks don't accept deposits, but they do underwrite security offerings. So investment banks typically make their money through fees charged. So through advising, they assist companies with mergers and acquisitions, or going public, and these are typically fee-based procedures. So deposit-taking financial intermediaries, they include our commercial banks that we just discussed, savings and loans, and credit unions. Then we have investment funds. So the savers have an ownership interest in a pool of funds, and these would include mutual funds, hedge funds, and pension funds. So mutual funds, this is where investors pool money to buy financial instruments. This can happen in the money market, a short-term market with low risk, or an exchange-traded fund allows investors to buy and sell during normal trading hours. Hedge funds, these are similar to mutual funds, but they're typically limited to institutional investors. They have a small number of high net worth investors that are included in with those institutional investors. They fly under the radar quite a bit and are not heavily regulated by the SEC. Pension funds, these funds typically own a large fraction of a single company's stock, and they often control these firms, and they're not publicly traded. Then we have our pension funds that also act similar to life insurance. So these life insurance companies take premiums that their clients are paying to them and invest that money so that if there is a death, they have the ability to pay that demand on cash. Pension funds are doing the same thing. They're taking those contributions put in monthly by the employee so that when they retire, they're able to pay those obligations. So transactions happen in either the primary or secondary market. The primary market is where securities are sold for the first time. So an example would be an initial public offering or a seasoned equity offering. The issuing company is directly involved in the transaction. So these are securities that have never been sold before. They're being sold for the first time directly to investors. They may use an investment bank to assist them with going public, but the issuer is receiving the proceeds. So whatever these securities sell for, the issuer is receiving those proceeds. The secondary market, this is where shares that have been previously issued are now traded between investors. So an existing owner would sell to another party. The issuing firm doesn't receive any proceeds from this sale, and they're not directly involved. So this would be like a stock exchange. So if stocks are listed on a stock exchange, that means that company is publicly traded. And the stock exchange is there so that investors can trade amongst one another. The issuing company is not involved. So if I were to log into my trading platform right now and sell shares of Walmart, Walmart wouldn't receive any money from that transaction. I would either take a loss or a capital gain whenever I sold that share of stock to another investor. Stocks are listed on stock exchanges. To do so, a firm has to file an application for listing, and they have to meet a lot of different requirements. An example is the New York Stock Exchange. To be listed on the New York Stock Exchange, you have to have at least 400 shareholders. You have to have at least 1.1 million shares of publicly held stock outstanding. You must have pre-tax earnings of $10 million over the past 3 years and a minimum market value of $100 million. Now, each exchange is going to have their own requirements. So the requirements for NASDAQ are less stringent, and they have different fees associated with them as well. So how do we differentiate between these different types of markets? We said that some stocks list on the New York Stock Exchange, some list on NASDAQ, some list on Amex. How do we differentiate between these? First up, we can differentiate by location. So are these secondary markets organized by location, meaning is there a physical location that exchange meets, or is it put together through computer and telephone networks? So is it just a computer that handles all of the information coming in, or is there one physical spot where all trading has to happen? The types of orders. So types of orders include differentiating between market orders and limit orders. So it's really just instructions on how a transaction is to be completed. So a market order is when a transaction is told to be sold or purchased as quickly as possible at the current price. A limit order is where the transaction only occurs in specific situations. So for example, you could put a limit order in to purchase a share of stock if the price drops below your minimum threshold for a certain amount of time. So for example, I could put in a limit order and say I am willing to buy Walmart if the price per share drops below $50 during this business day. Secondary markets can also be differentiated by the way the orders are matched. So there can be electronic communications networks where orders are matched automatically. So a computerized system matches orders from buyers and sellers automatically to execute transactions. It's very cheap for orders to be matched this way. But what we primarily see are broker and dealer markets. And so let's discuss the differences between broker and dealer markets. Whenever I think of a broker market, I like to think of a real estate broker. So hence the house here. A real estate broker. That's something most of us have encountered before. When you purchase a house from a real estate broker, that real estate broker does not own the house that you're purchasing in most circumstances. They're receiving a commission for the sale of that house. That's the way that broker markets work when we're talking about security exchanges as well. So a broker brings two parties together. They bring the buyer and seller together, and they are receiving a commission for that sale. An example of markets that use broker markets are the New York Stock Exchange. Dealer markets, I like to think of a car dealer, particularly a used car dealer. When you go to a used car dealership, that dealer owns the car that they're selling you. So they purchased it from someone else, maybe a trade-in, maybe they went to a car auction, but they purchased that car prior to your arrival. And now they're trying to sell it for more than they paid for it. That's the same way that dealer markets work when we're talking about exchanges as well. So the dealers keep an inventory of the stock that they're trying to sell. They place bid and ask advertisements. So this is the price that they're willing to buy or sell at, the bid-ask price. The key difference between broker and dealer markets is a technical point dealing with the way trades are executed. When a trade occurs in the broker market, the two sides are brought together and the trade takes place at that point. The dealer market, the buyer and seller are never brought together directly. So there's essentially two separate trades being made. The first individual sells their security to the dealer, and then the dealer then resells that security to the second individual, and they make their money on the difference between the bid-ask spread. In recent years, distinctions between broker and dealer markets have become blurred simply because they're being transacted so quickly that these dealers are likely to only own the stock that they're selling for partial seconds. These transactions are happening so quickly. With dealer markets, there are no centralized trading floors, so these market makers are linked together using telecommunications networks. Examples include NASDAQ. So there are different types of market transactions. First, we have an initial public offering. Then we have a seasoned equity offering. And then we have the secondary market. So both the IPO and the SEO happen in the primary market, which we've already discussed. The secondary market are where previously issued stocks are traded amongst investors. So IPO, stock is sold to the public for the very first time. That company has never had shares of stock that have been publicly traded before. A seasoned equity offering, this is where a company that already has shares of stock outstanding in the primary market or that are publicly traded, they already have publicly traded shares, and they want to issue additional shares. So then they return to the market, they sell new shares of stock, but this is an existing company, so people already know something about them. They already know what these shares of stock are worth, and they sell this stock. Oftentimes, they sell the seasoned equity offering. They go directly to those investors that are existing today and offer them additional shares of stock.